Anyone who started homework? Tried homework? Any question? Any clarifying questions? Okay, I'll ask the same question at the end of this class, okay? So think about it. Okay, what seems to be the news today? Well, the 30th September and another date, 17th October this year. In the U.S., well, the first agenda is by the end of today, U.S. local time, will U.S. government shut down because their budget may not pass Congress, and also there is a battle between White House and the Congress about whether to increase the ceiling of total spending. Okay, markets anticipation is, well, it's going to be passed anyway, but how long it will take? Okay, so when I checked the site, Financial Yahoo, and what it says is the index called a volatility index, ticker is VIX, has been rising. Okay, so it's about 15 point something, 15.46. Okay, so that figure has been increasing over the week, over the last week, about 18%. Okay, now what this number means? Well, actually, if you read this number, let's say 15.46, this is the market's anticipation about the volatility of underlying, which is Standard & Poor's 500, for up to 22 working days. So it's about 30 days in calendar date. So it's the figure about the volatility in the stock index, S&P 500, for the next 1 month period. Okay? So if this figure starts rising, and that means markets anticipating more volatility or uncertainty or shocks for the next month period. So when you try to judge whether in fact 15.46 is in fact some serious number or not, of course you have to compare it, right? It's all relative. So when I actually checked the longer historical data from the same source, we are at here. Okay. So if you go all the way back to the period right after the Lehman crisis, so this is the start of 2009, so that's right after the Lehman crisis. So it has been very high, up to, I believe that figure is, this is 1040 or 50 or 70 or something. So it's very high, right? And since then it's been stabilizing. So actually, if you calculate comparable figure for this using historical S&P 500 sequence, you will have probably approximately a 15. That is a long historical average. So 15.47 is slightly above that, but it's not that huge number. But those numbers are quite huge, right? So as you can see that we need to first learn how to come up with that kind of figure. But even if we don't do that yet, still we can see that the level of volatility or market's anticipation about future volatility in the stock market or the financial market in general appears to be changing over time, right? Not constant, it's changing over time, right? So we try to learn the techniques that yields this kind of number and try to interpret it, and hopefully we can build a model so we can predict those figures. Okay? So that's the section added to the previously distributed lecture material. So actually, what is volatility? Well, volatility is defined, well, in a probability term in this way. So we say, well, if you have random variable x, so random means it's uncertain, right? If you take the absolute value, because it can be positive or negative, you can think of x as a stock return and y as stock return for another company. If you take the absolute value and if you compare, and actually if you pick some arbitrary number c and calculate this probability, if you can do that, if this probability is higher than that, greater than that, and we say x is more volatile than y. Okay? Well, of course, later we'll provide specific meaning about what this thing really means. But let me show you another sequence here. And probably not many of you have seen this sequence before. Well, this series, this dark one, is what we call as total return index. Total return index. That is computed for a Korea Treasury bond. Okay? If you want to know whether stock market has been good today or not, what you look at is KOSPI index, right? KOSPI. That's because there are many hundreds of stocks are listed and traded in Korea exchange. Okay, so some stock rises, some stock falls. So you can't see actually by just looking at individual stock price movements, you can't judge whether market has been in general going up or down, right? So you create index, so you are actually shrinking those hundreds of stock prices into single number. That's the index, right? So if you can do that for stock market, you should be able to do so for the bond market as well, right? Because size of the bond market is usually greater, much greater than stock market, right, these days. So this one is assuming that if you invested $1 here, okay, what has been the value of that if you invested your fund to all those Korean Treasury bonds? So we know that Treasury bonds have different maturities, right? So different maturity Treasury bonds are issued, in interval, and something matures and new issue is offered. Those things are kind of going forward this way. So if you actually track all those bonds traded in the market and in somehow calculate the value of that, then you can come up with this kind of index, what we call total return index. Okay? So when you try to allocate your asset to, let's say, stocks or bonds or the combination, okay, then usually the reference point is what is the expected return from investing to stocks or to bonds. So expected returns are important input for your decision, right? And also you need to know what is the risk involved in such investment. Okay. So that risk is measured in terms of volatility. Volatility of stock market and of volatility in bond market. Okay. And third piece of information is what is the correlation between these two markets. So if these two, bond and stock markets, are perfectly correlated, let's say perfectly positively correlated, and what that means is if you earn something from stock market, you will also earn something from bond market. Okay? At the same time, if you lose from stock, you will also lose from bonds. That's perfect positive correlation, right? So in that case, you are not gaining any benefit out of a diversified portfolio. So you want to construct your portfolio to some in stock, some to bonds, but hopefully the correlation is not 100% or 1.0, so that if you lose something from one market, hopefully you can gain from the other market, right? So it could be compensate each other. So as you will see later, volatility in both markets will vary over time. At the same time, the correlation between these markets will be time varying. Okay? And our task in this course is how to measure them. Okay? And sometimes if you have, let's say, 22 industries, and if you try to figure out which portion of your investment should be to particular industry, then in that case you have to calculate very big variance covariance matrix where you measure volatility for each industry, 22 industries, and also you have to measure the covariances, right? So that's huge number. So like 22 times 23 over 2, that's the figure, the numbers you have to calculate. And the worst thing is those numbers vary over time, right? So how to handle those practical situation, that's our task. So you've seen this. This is the case of Korea Treasury bond. And if you happen to look at bank debenture, bank also issue bonds, right, to fund. And if you invested to bank debenture, and this is the total return index that corresponds to that. Okay? If you invested stocks, let's say, in terms of market capitalization, when we say market capitalization of a particular company, what you're saying is you are multiplying current stock price of that company and to number of shares outstanding. Okay? So million share is traded at, let's say, $1,000, then multiplication of these two figures will give you market capitalization of the particular company, right? So if you actually looking at all those, let's say 1,000 companies listed in the stock market and calculate market capitalization for each company and sort it from the large stock to smallest stock, and then actually you can group it from here some large capitalization stock, large cap stocks, and some group of small cap stocks. Okay? So if you invested here, then what this kind of figure shows is if you invested to large capital stocks, and it will grow more than small stocks. Okay? Of course, this phenomenon may look weird a little, because usually smaller companies are riskier than large companies, right? So usually the market wisdom is smaller stocks are usually having greater expected return associated with higher risk compared to relatively smaller expected return with less risk for the large cap company. But in Korea, it doesn't seem to be the case for this particular period, right? So first thing, mechanical thing, the volatility is, in a simple term, it's the standard deviation. Okay? So if you have a stock and calculate return, calculate deviation from sample mean, square it, and calculate the average of that square deviation, and that's your standard deviation, right? Okay, so what are real numbers? Well, when I tried several exercises, let's say first the term continuously compounded annual total returns, right? So year T plus 1. So stock price T plus 1, right? So there are two ways of calculating returns. One is return is return in percent is calculated by usual formula for rate of growth, right? Or in this way. You can rewrite it if you prefer. This way, the same thing, right? This measure, we call it simple return. This measure, we call it continuously compound return. The difference is, well, the simple return is comparing this date and that date. Right? But for this measure, if you calculate it this way, actually you are looking at the situation like this one. If you compare some other period like this, so value of P will change, right, slightly, and calculate return. And if you have positive return and you reinvest it, okay, here. Of course, if you lose it, then, you know, the principal will shrink, right? So if you keep reinvesting over the period, what would be your return? That's the concept. Okay? So the other relationship you can easily verify is if you take 1 plus of this thing and take natural log, and that is similar to this one. Okay? The reason why I emphasize this distinction is that usually we play with this number, which is this one. The motivation is when we actually look at return, simple return, it doesn't look like normal. Okay? But if you actually transfer this figure just simply by adding some constant, and this natural log function is monotonic function. So just simply changing the measure from simple return to log return, then this one appears to be more, well, actually closer to normal distribution. So usually we make assumption in many analysis in finance that this continuously compounded return may be approximated as normally distributed random variable. Then many of the calculation is much simpler. Okay, this one. So I take S&P 500 large cap company total return for this period, about 30-year period, and calculated mean of 11%. So annual return is about 11% during this period. Okay? And standard deviation was about 0.1556, so 15.56. Because this return is measured in terms of annual return. So this is the figure. And actually this figure is comparable to previous VIX. Because VIX is somehow converted to annual figure so that those numbers are comparable. Okay. So historically, of course, we have more observations since then. But if you look back, this period, about 11% of expected return is associated with about 15.6% volatility. Okay. If you actually work out the same calculation using monthly return, okay, then for the same period, mean was this figure, and standard deviation was this figure. So, can you compare? Well, does it make sense to compare this number and that number directly? Or does it make sense to compare this and that number directly? See, you're looking at the same period, right? There is only one market, right? S&P 500 market. So performance has to be measured in the same figure, right? But depending upon the frequency of data, numbers doesn't match, right? So in somehow, you need to unify the metric, the units, right? So this is the way. So if you accidentally calculated monthly return, the total return from monthly return, and these times that 12 to make it annual, these numbers are the same, right? Usually in practice, you will work more often with monthly stock return, right? But even though you are working with a monthly return, in many cases, for comparison of stock market with other markets, you usually annualize it. Okay? So this figure is important, not this figure, right? So about 1% a month, that's what it is, right? So if you assume that you're earning 1% a year per month over 12-month period, then you will earn about 12% return, right? How about standard deviation? Well, if you computed this number, right? The way you make it annual standard deviation equivalent is to multiply square root of number of trading month. So if there are, there are 12 months, right? So square root of 12. Then this figure is now very close to previous number, right? So if you accidentally computed quarterly return and computed standard deviation from that quarterly return. And to make it annual, you are multiplying which number? Square root 4, right? Correct. Square root 4. If you computed standard deviation using, let's say, daily data, then you expect this number is going to be very small, right? Then how to annualize it? Multiplying that figure by square root of number of trading days a year, right? How many trading days a year? About 250, 52, 55, 50, it depends on, right? Holidays. So you usually assume, let's say, 255 is the annual trading days. So that's working days. So you multiply that figure to get annual figure. If you are making other assumptions, there are different ways of computing annualized version, but forget about this part. Usually this is market practice. Okay? So we call it square root rule. Square root rule. Correlation, well, we've seen this formula already, right? So correlation is simply covariance between two variables scaled by standard deviation. Okay? We've seen autocovariance, autocorrelation, right? If these are the same thing, right? So what is the when I looked at annual stock return for the same period, and monthly one, and the bond return out of total return index, correlation was about 0.3 during this period, okay, using monthly data. Right. Large cap stock, long-term government bond return. Okay. And the covariance is this one. This one. So very difficult to see what this number means, right? But when you convert these three numbers to this one, you have clearer picture, right? So about 30% correlation between stock and long-term bond return, right? How about, well, you calculated correlation using monthly data and found about 30% is the correlation. What if you annualize it? Well, covariance, so there are 12 months. When you compute annualized version for standard deviation, you multiply that by square root of 12. But when you calculate actually the variance or covariance in annual term, multiply not by square root 12, just 12, right? Because sigma is the square root of sigma squared, right? So this is covariance, annual version, but still covariance is about that figure, right? So actually, without annualizing it, it would be better if you actually used annual figures, right? Annual figures. So this is more correct numbers. And this is actually the approximation. But if you look at annual data, number of observation could be small, right? So to increase your number of observations, you may work with monthly data, right? Then you have to consider there's usually some margin of error, right? But not that big in this case. Okay. Here is another second way of measuring this volatility. So our first measure was covariance, standard deviation, and correlation, right? Those things, just unconditional moments. This is second. But before I move to that part, you might be confused about how to increase sample. Okay? Whether GDP follows random walk or not. Well, some people say you need more data to determine it. Okay? Whether stock price is, well, in fact, in Korea, 2,000 is wrong average. That's if stock price is in fact mean reverting process or a stationary process, well, it will return to 2,000, right? But to figure that out, you need to have a long historical data because what we have is something like this, right? So if we live another millennium, then it may go down this way, and then another millennium, it may go up, right? But our stock price sequence is available for a particular period. Okay, so if you look at annual numbers, how many? Maybe less than 100, right? So you decide to calculate, collect monthly observation. So if your data has 50 annual observations, and of course, multiplying that by 12 monthly, well, you are actually increasing number of observations, right? Is that really increasing number of observations? Well, going from annual to monthly, of course, you are increasing observations, right? Number of observations, literally. If you want to make the series longer, well, you can take a look at this daily data, right? But the thing is, suppose this is the annual data, okay? And you want to see whether this sequence is in fact reverting toward mean. Okay? But you don't know whether there exists such as average, right? So here on, it could go all the way up this way, right? That's a possibility. Right? So what you actually need is, if this is in fact really the average, and if this series is in fact mean reverting, then what you need to make you more confident is the episode like this one. So if you observe this kind of event more often, then you can be more confident that this sequence is in fact mean reverting, right? But if you are working on this way to increase sample, what you're seeing is this. Are these adding any new information? No, right? So when we actually say we are increasing the sample, we mean this way. Okay? Not going this way. So that's the one thing you might want to remember. Okay, what is then historical volatility? Well, the concept is very simple. You are calculating moving standard deviation. So the formula looks awful, but it's very simple concept. Let's say you pick horizon or window, what we call window, N. So suppose you are working with monthly returns and you want to calculate so-called historical volatility. Here's a step. As of today, if N window is 60, so 60 month, okay, then collect 60 observation from last month up to 60 months ago. Okay, so 60 observation, and calculate standard deviation and record it today. Okay, and next month you are moving window forward by 1 month, keeping this N number of observation, which is 60 in this case, same. Calculate standard deviation and record it today. Okay, and next month you are moving this window again, holding this N constant. Calculate standard deviation. So in that sense, the name historical. Okay? So to calculate today's standard deviation, you are using past N periods return. Okay? So this is the formula. The variance, so you take square root of it. Right? To annualize it, of course, multiply square root 12. Right? The correlation, historical correlation is the same thing. You have sequence A, sequence B. And just look at the window and calculate correlation and record it today. And continue. Right? So actually, if you do that using S&P large stocks and long-term government bonds using previous data, do you expect this sequence, this one, if you plot over time, will it be straight line, horizontal line, or will vary? It will vary, right? Because you are picking 60 observations from different period, right? So it is expected to change over time. So we know that stock return has some sigma uncertainty, right? And the question was how to calculate this number as a t, right? So if you have observation 1 through cap t, all the data is available, then you can calculate this number as a single number, right? But the data scheme is, how about this figure at this point? So these data are not available. Then using previous data, right? But not all of them, just previous n number of periods. Okay? So each time you are calculating that figure over time, what it tries to calculate is this one. Because formula is the same, right? Formula is the same. But depending upon your sample, or we say because of sampling error, numbers is going to be different over the period. So actually, when we do the exercise, let's set, again, assuming monthly data, let's set window size as one 36 months and the other one 60 months. So looking at 60 months, 60 months or 36 months, right? For the same period, in the same data. Actually, these are the return series, total return series, large capital stock and long-term government bond. Data look like that for the period. And if you want to calculate this thing in EBUs, okay, you can try this kind of calculation. And here is the answer. Historical volatility using continuously compounded total return. So first one is a stock, long-term, large capital stock, setting N, number of size of window, 36 months. The other one, same data, but using N equals to 60 months. Okay. So 6 months and 36 months. So if you are working with smaller window size, more volatile figure, right? What if you increase this one to exactly the same as number of total observation? Can you calculate this kind of spots here? No, right? If you're setting this one as close to historical, the total number of observation available, then you can calculate that number because window covers this long, right? So at the end of a sample, you can calculate only a single number, which is this. So if you actually calculate it at the end of a period, you probably get some number like this one, 15%. Okay. But because of different window size, you can see that more volatile period here, there, and there. Right? Roughly, what happened in the United States, around this period, we had first oil shock, right? And 78, 79, their second oil shock, right? And here, Iraqi war and the U.S. recession. Now, those big events make things look more volatile. Right? So these are all comparable annual figure. So if you look at, let's say, what would be the average value? You can see that. You can see from previous slides, 15% is about the average, right? So sometimes it's higher. And sometimes it's quiet, more quiet. Right? So if you want to compare U.S. market and Korean market, let's say stock market, you have to do the same exercise for the Korean market and see what is the average value. In Korea, probably you'll get some number like 20% about this level as average. So matured market like US is about 15% as a uncertainty measure, volatility measure. And emerging market like Korea, riskier, so about 20% on average. Right? That's what we expect. And also, because of many news and crisis to Korean stock market, we probably see more peaks. So when I go back to this slide, let's make this one big. Okay, right after Lehman in the United States was about 60. So about 4 times more volatile. Right? So what would be the impact of government shutdown in the United States? This number? No. You never know. But the current market's anticipation is about 15.4. So which is still, well, over the last week it's been increasing, but the level itself is not that unusually high, right? Okay. Oh, sorry. Trying to make it smaller. If we continue our exercise using stocks, previous one, and the bond. Now set window, moving window as 36 months for stocks and bonds. Okay. So this is the case of stock, and this is the case of bond. So bond market on average is lower, right? Much lower. And this is a long-term government bond. So of course, that's usually what is regarded as safe asset, right? So the figure is like less than about some number like this one, 7%, something. The correlation appears to be changing over time. Setting n equals to these figures, if you calculate correlation between stock market and bond market in the US, it appears to be the case that the 30% is about average, long average, but sometimes higher or lower. And probably you learned it from basic finance course that if you find 2 assets have low correlation, then having diversified portfolio using these 2 low correlation assets will in general lower the risk, right, of your investment. So if you want to hold these 2 at the same time, these appears to be the better period than this one, right? Let me explain this part and show you some sample program. Well, this is the this third version that allows us to calculate volatility. This version is called, has a lengthy name, exponentially weighted moving average, or EWMA. Okay? And the formula is this one. Okay? So suppose RT is return as usual, okay? Continuous compounded monthly return, and sample mean. So y of t is a deviation, right? So previous n squared returns in terms of deviation is a sum, and that is divided by this one along with weights 1, lambda squared, and so on, right? So if you set lambda equals to 1, lambda equals to 1, the formula is very simple, right? So all lambdas are 1. That means square deviation is summed over and divided by sample size. That's standard variance formula, right? So that's the historical volatility formula, right? But the difference between historical volatility and this measure is the weight. So what is the weight to the current, the latest observation as of t, time t? The previous one, right? So previous one has a weight which is 1 over this constant. The next one has lambda divided by this one. So if lambda is less than 1, then remote past will have smaller weight than this one. And actually weights are declining exponentially, right? Exponentially. So the name exponentially weighted moving average. Okay? So we call lambda as a smoothing constant. And if you are working with monthly data, here, monthly data, and usually, in the industry, people suggest 0.94 is a reasonable figure. And if you're working with daily data, then 0.97 is the suggested value. Okay. Of course, these are arbitrary numbers, but those are two benchmark figure. So if I calculated exponential weighted moving average version of volatility using a large capital stock and setting n equals to 36, this one, historical volatility, is the one you've seen previously. Okay? And EWMA measure is this popular one. Of course, numbers are different, right? But overall picture appears to be similar, right? But because of weighting scheme, the difference occurs particularly in the period like this one. So when there is a shock, this one increase, right? But this measure increase is much bigger, right? And then, if you calculate moving average, if there is a shock at let's say today, right? Then when you calculate historical volatility or exponential weighted moving average, when you calculate those volatility figures, the event, this one, that made this shock big, will be included in this window for n-1 period, right? And then this one will exit from window, right? So the reason why you see this historical volatility have this kind of box shape is if there's a shock at this period that making this number big like this, will stay in the sample. So it will slowly decay and then, right? But the decaying factor is fast, big, so this is going to be much faster. Right? So if there is a latest shock in the market, that effect is more reflected in this measure, right? And then the dissipation of that kind of information will be much faster compared to this measure, right? So in the industry, you see that this measure is frequently computed. So the one of the reason is, of course, there are other alternative measures that allows you to calculate sigma volatility. Okay? But one of the reason is it is simple to calculate, and it won't fail. By that, what I mean is, if we have, let's say, time series model that allows to measure this one, what if your model cannot, you can't produce model estimate because of some recent observations. If you can't estimate those model parameters, let's say, it's very simple, similar to ARIMA modeling. You estimated P1Q model and estimated parameter pi's and theta, right? But if you add more and more sample to your estimation problem, at some point you may not be able to calculate pi satisfying stationary condition, right? That could happen, right? Theoretically happen. But this kind of measure can be computed whenever you have data, because you're not actually estimating anything, right? You're assuming lambda as 0.94 if you're working with monthly data, and data are usually flowing in, right? So there's nothing that would fail your calculation. So people use this one because it's simple. But here's a question. So you are at the end of a sample. What is your volatility forecast? What is your volatility forecast? Well, it appears that historically it's been moving up and down, right? Up and down. So will you say it will go up and down like that? But how to come up with actual forecast? So if you want to calculate this number at t plus 10, you can't calculate it, right? Because you don't have data, right? T plus 9, T plus 8, T plus 7. Those data are in the future, right? So you can't calculate that figure for T plus 10, which is your forecast, right? So your forecast is using latest information, let's say up to last 36 months, you come up with some number like this one, right? So this is your best forecast. So your forecast would be this, because no other information, right? So if you use this measure, then your forecast is simply this. Right? But later, when you actually build a time series model for this conditional volatility, if you look at historical plot, it appears that there is a kind of long-term average. Right? We know already that long-term average was about 15%, right? So this is about the average. Right? And historically, it's been more tranquil than average, sometimes more volatile than average, right? Then this and that, and this and that. Okay, so many we can assume that volatility is kind of smooth, not moving this way, right? It's just smooth, but it's kind of not exploding, right? And it tends to revert toward mean, right? Revert toward mean. So the model we see, time series model we see, is to model this period in a particular way, and so that actually, in fact, you are at this position, then your forecast is not likely to be that way, because this is historical average. Your forecast is going to be something like this. If you happen to be here, then your forecast is going to be this way. Very similar to Riemann model forecast, right? If there is a mean and forecasting it toward mean. So that's another measure, but we'll get to that shortly. Calculating this number, over and over is kind of quite tedious job. So here is the method. Don't worry about this part. Let's take a look at this part. Okay. How to calculate sigma squared at t? Okay. We know that if it's monthly data, then we know that lambda is set to, let's say, 0.94. That's assumption, right? And this is the data, right? And this is previous one. So if you know previous observation and previous EWMA measure of volatility, then you can calculate this one. Okay? And continue that, right? How about covariance between variable number 1 and 2? Well, according to this scheme, the variance has something to do with the square of the original value, like this one. Covariance is, of course, different one, right? So if you know these two numbers and the product and covariance in the previous period, then you can do it, right? The question is how to start in the beginning. Suppose you are at t equals to 1. What is the value at t equals to 0? No value, right? No value, right? So somehow you need to start. If you start that calculation, then you can continue, right? Very easily. So let me show you how to do it. So you take a look at, well, keep in mind, this is your formula, and I'll show you the program. It's in different directory. Yeah. So the version like this one, the program like this one is already stored in this name. So later, check it out. But here is the situation. Here is one interest rate series. Let's say, what was the name for that? Check this one. I guess the first one is 10-year treasury bond as of August this year. Okay, so 2 months ago. This one is the 3-year KTB, correct treasury bond yield, so 2.94%. So ours is slightly higher, right? Of course, this is the 10-year and this is 3-year. You want to calculate the volatility of U.S. Treasury bond 10-year and 3-year Korean Treasury bonds, okay? And try to calculate what is the volatility, annual term, and the correlation between these two. Right? So this is data. Then this one is the first one. Okay, so first thing is you have to define R, right? R. What is R? Interest rate. Well, if you have, let's say, interest rate 4.5%, 4.23%, this type of, let's say, monthly interest rate, this is usually, when you actually try ADF test, this is non-stationary time series. So calculating standard deviation of this thing itself has no meaning, because interest rate could go down this way some points go up, right? There's no average return value. So when you have non-stationary interest rate like this one, the first step to define RT is to take difference. So difference. So this is my step, right? Difference. So calculate difference sequence first. If you have, let's say, stock, this is case of bond. How about stock? 2011.2, 2009.3. If it is cost peak, right? Some numbers. This is also non-stationary time series. Okay? So do we do this? In this case, of course, we are calculating this, but log difference to make it return, right? So if you multiply that by 100, that's the stock return in percent, right? This one is already in percent annual figure, right? So what is the change of something measured in percent? Acceleration rate? No meaning, right? So if you have most of the value like this one, you are taking log difference to make a continuously compound return or growth rate, right? But if you have something expressed in percent, calculate change in that, right? So unemployment rate is another non-stationary time series. So to calculate a volatility of unemployment rate, you will first calculate change in unemployment rate and proceed. Okay. So you calculated this, and now at time t equals to 1, so first observation, you don't have previous numbers, right? So if you don't know anything about previous one, you have to make an assumption. So take a look at this one. Let's see what it says. The first one is to compute EWMA covariance. Okay, EWMA covariance. So looking at this series, B and C, right? So change and change, right? And multiplied. So because you have no idea about what the previous value before the sample period, so your initial guess about this number is simply the change in net. So to calculate change, you need to use these two, right? So calculations start from this cell. Right? If you are looking at the variance, of course, because you're looking at the same thing, right? The same thing, B, right? How about, let's say, next one? So taking square root, it means you're making the variance to standard deviation, right? Volatility. So inside this square root function, $M$1, M is right there, right? That's that lambda, value lambda, right? So let's fix that as that. So lambda is there. And you don't want that figure change, right? When you actually copy this formula. So to make this cell fixed, we put dollar here and dollar there, right? So this one time L16 is the previous one, right? L16 squared and 1 minus lambda and this one, which is previous one, right? Now you have a data here, right? Previous one, right? So previous one. This change is available now, right? Covariance formula is the same. Right? Covariance formula is the same. The difference is now this time cross product. Right? So by writing this for, let's say, 3-year Korea Treasury bond, so actually when you calculate these three, and then you can copy this formula. All the way down to here. Right? What is this one? And the correlation. Of course, this is EWMA standard deviation for variable 1, variable 2, right? This is covariance. So correlation is, of course, this divided by these two numbers. Right? So correlation. So first number, because of this assumption, initial assumption, this number appears to be weird, right? So that's not that accurate figure, right? So these, as you move along downward, then probably number gets quickly, converged to what appears to be two numbers. Okay. Now this is not, well, the correlation measure is unit free, right? Because basically it is scaled by, covariance is scaled by volatilities, right? So it's scale adjusted, and you should lie always between -1 to 1. So correlation is simple, just one sequence. But this one is important. You are working with monthly data, and you want to annualize it, right? So here, what we did was L16, which is this number, and square 12. To make it annual figure, right? But the numbers are already expressed in percent. Percent, not decimal. In decimal, it could be 0.0452, right? 0.0452 or 4.52%, right? So it is already expressed in percent. We don't multiply that by 100, but we have to annualize it because this is the monthly change, right? Monthly change. Even though this is annualized figure, right? This is annualized interest rate, but still this is a monthly difference. So square root rule is applied here and there, right? So when you do this, then you can also calculate, right? So pick this corner and get this pointer and then extend it, okay? So I plotted this one here. So this is a slide I used in the other presentation. So before you look at that, to get some idea, let's go back to the volatility. of this one. Long-term government bond, long ago, right? This one. So average was about, it's quite low, right? Annualized, let's say about 8% or less, right? These are unusual period when in the United States inflation was very high, so the volatility was also very high, but that's not historical average. So before and after 2000, U.S. capital market is also very much calm. So if you look at the scale here, about 4% and 8%, right, that region. So we are looking at historical average going this way, right? And now looking at the latest figures here. This is the U.S. figure. 0.4 is right there, 0.8 is right there. And during Lehman crisis, up to there. So when we talk about stock market, the volatility is on average like 15%, right? But in the bond market, even if it's in a crisis, it's still very small, right? Very small. If really, if government bond is a really safe asset, the volatility has to be zero, right? Zero. But in fact, it's not zero. So usually, like low figure, but toward recession crisis, it climbs up. But still, the magnitude is very different between bond market, of course, government bond market and stock market, right? So Korean treasury bonds for 3 years, very similar, right? Very similar, much lower than that. The correlation, EW correlation, is about 0.5. So if something happens, like tapering decision in the United States, and some bad news like government shutdown in the United States, this is likely to go up, right? But our correlation is high, right? So ours are expected to go up, right? So suppose our crisis is not over, right? The uncertainty in the world market, particularly in the bond market, is not clear. So let's say historical average is about somewhere between this figure, right? And still is higher than that, right? So suppose you are the risk manager of financial institution, and now you want to see what would be the damage of rising interest rate to your institution. Well, according to this figure, let's say currently about 0.5% per annum, is it likely that interest rate go up by 1%? 1%. From here, is it likely that, well, if something happens, right, something bad happens, is it likely to go by 1%? Well, see, in a normal period, we are in a normal period, it is about like 0.5, right, per annual basis. But if something happens, the volatility could go up by, let's say, more than 1%. More than 1%, right? So it could go up by 1%. this is standard deviation annualized, right? So this figure is just one standard deviation volatility, right? But usually we say 2 standard deviation volatility, 3 standard deviation extreme cases, crisis. So it could be like 2 standard deviation means 2% or 200 basis point, or 3%, 300 basis point, right? So that could happen. But those figures, what if analysis, what if our interest rate goes up by 1% or 2% or 3% from current level, which was about this figure. So from 2.94% to 3.94% if volatility rises up to this point. It's highly likely, right? Highly likely. In the United States, of course, they are likely too. Okay. So this is EWMA volatility, and this is another version for US and Korea, right? But if you presented these figures instead of this annualized figure, the people will have very different interpretation, right? See, comparing 0.21 to 0.499. This is the before. This is monthly volatility. This is annualized volatility. And these numbers are in annual figure, right? So you have to make it annual, right? One of the company in a financial industry, he believes that he is looking at a particular interest rate as a benchmark. Let's say 5-year treasury, Korean treasury bond yield. Okay, let's say that is 3.2%, and his feeling, his gut feeling is if that interest rate and the interest rate, he is concerned that the gap rises more than 100%. I'm sorry, the 1%. So 100 basis point, his company may shut down. So it's very, he's pretty much in trouble, if in fact this type of volatility is actually realized. So hopefully you get the message about the importance of this kind of figure in actual understanding of the riskiness of the market and the way we compute those numbers and interpret it. So we covered up to EWMA measure. This one, in this case, company if you look at BSPL, a balance sheet of company, left-hand side is asset, right? Right-hand side is liability and equity, right? Typically. And of course, if you are listed common stock, then this value is valued every time, right? Stock market value this one. But usually this is not, right? So there is no market value for asset as well, because this is not valued, right? So theory comes into this situation and somehow design the way we value this one. So if these and these, if this is valued along with market information, you can value this one, right? So what I did here was to calculate the value of asset for particular companies, 2 companies. So that the value of asset plays like the role like this one. Okay? So in this case, not taking the difference, taking log difference. Okay? And did the calculation again. And these are the annualized figure. And this particular companies, when they are heading into this global financial crisis, Lehman crisis, it's been rising from here to very high level. Right? And these 2 companies accidentally belongs to the single mother company, and their correlation is very high. So that means if the value, there is a threat to the value of asset to a particular company, another subsidiary could go into trouble. Right? So if you are financial group or other group in the manufacturing industry, you want to have those subsidiary companies having less correlations with each other. So, right? So if one goes wrong, it doesn't contaminate the others. But if this is this high, then there's a probability, higher probability, right? So to judge that kind of situation, it is very important to calculate those time-varying volatility and correlation.